Welcome, everyone. Thank you for joining us today for our webinar, AI-driven investment strategies for traditional investors. In this webcast, we will explain some of the ways traditional investors find results with AI-driven investment strategies and how your organization's journey to an AI transformation can be very simple. I'd like to begin by introducing our speaker, Erik McBain. Erik McBain, CFA, is the Director of Growth at Boosted.ai and is responsible for accelerating revenue growth through the attraction, targeting, and acquisition of large global customers. Erik is passionate about the application of emerging technologies such as AI, machine learning, and big data strategies to various facets of the investment management industry. Prior to joining Boosted.ai, Erik was the Director of Growth at MindBridge AI, where he was charged with building, scaling, and expanding the global sales organization. Erik is a CFA charter holder with over 15 years of institutional investment management experience with organizations such as Deutsche Bank, CIBC World Markets, and Bank of Canada. Without further delay, I'll pass it on to Erik.
Thanks very much, SK. I really appreciate that introduction, and I really appreciate the big group of attendees that we've been able to collect. And I think today what we really wanted to do is kind of shift it a little bit from some of our prior webinars where we took a real focus on the more technical aspects of building machine learning platforms, applying machine learning in a very technical way to the financial services use case, investment management use case, and what we're trying to do maybe with this seminar is offer a little bit more relatability and kind of approach the exercise from that of a more traditional investment professional, someone with a business degree, an MBA, a CFA, but maybe doesn't necessarily have a deep coding background. And I think it kind of reflects a little bit of the diversity that we've got at Boosted. On one end of the spectrum, we've got guys like Joshua Pantoni, who's our CEO. So he is an incredible machine learning engineer, and kind of built this product from scratch, but that can be a little bit intimidating, I think, for a lot of maybe older school CFA non-coders that say, okay, well, that's all fine and everything that this machine learning PhD can solve the financial markets, but what about me? Is that something that I can then apply and integrate into my process? And I think by kind of offering my perspective and coming at it from someone with a CFA and more of a traditional business background, I think I'll try to level the playing field a little bit to show that there is a lot of huge advantage that can come from taking explainable AI systems, decision-making aids, and then putting them in your investment toolkit to reach better outcomes. So what we'll do today is we're going to start with a machine learning overview, just kind of some broad brushstrokes on why we can do what we can do today. Talk about the shifting investment landscape and some of the challenges and opportunities that present in the what we'll call institutional asset management industry. Talk about quantamental as kind of a theme. This is kind of combining the best of what are very advanced quantitative techniques, machine-driven, more algorithmic trading, with some of the more fundamentally based investment approaches, which you can kind of align with a traditional kind of Warren Buffett, more of a financial statement analysis, CFA curriculum type approach. We'll talk a little bit about Boosted as a company and what we, how we approach the exercise, and then we'll end the discussion with some question and answers. So, let's kick in here. I think it's fairly commonplace that AI really has transformed the way that we do everything. I think there's been a lot of hype and hyperbole around the potential, and this is not a new technology, but there are some things that have happened over the past 15, 20 years that have really created this fertile environment to create these powerful machine learning systems to assist human decision makers and to help us solve some of our most challenging problems. And I'll articulate some of the really good reasons and specific reasons why things have accelerated in the last few years. I think SK had alluded to it, but I have kind of a unique background in that I spent my early career working for Deutsche Bank and some of the large sell side investment banks in kind of a sales and trading role, and then went to the buy side and managed a large fixed income portfolio. But prior to actually joining Boosted, I was with another AI company called MindBridge, and MindBridge is an interesting business in that we had created an AI auditor, and it was effectively a tool in the toolbox of a professional auditor that allowed them to find the needle in the transactional haystack. And what was interesting, and what I think I learned from that experience is I think the most successful applications of AI that I have seen and that I'm most excited about are these human in the loop, basically assisting and augmenting technologies that help professionals make better, more data-driven decisions. And you see this in the audit industry, you see this now in the insurance industry with intelligent claims processing. I've got a friend, Ben O'Leary at Blue Jay Legal, that has built a very powerful legal system that augments the abilities of a research intern to scan through huge amounts of case material and to find reference data in a way that was difficult to replicate with anything but just kind of caffeine fueled hours for the most junior people in the law firm. And I gotta love the healthcare applications. This idea of putting these very, very powerful prediction engines in the hands of doctors to make better decisions. And these all fit into, I think, an economic framework that was proposed by a group of professors at the University of Toronto that wrote a really great book called Prediction Machines. And what they propose is, the human decision is made of two key components. The first piece of that decision is a predictive element, with the second piece always requiring human judgment and interpretation of those predictive elements. And we historically used a lot of intuition, we used a lot of heuristics and rules to kind of approximate some predictive accuracy, but we always had to make some kind of judgment call for a decision to take place. And I see these machine learning engines and these decision-making aids kind of displacing some of that predictive capacity. I kind of think of the tool that Boosted has built and some of these other kind of AI, human plus machine, as kind of augmenting and kind of maybe displacing some of that predictive power. So what are the three forces that really brought this to the fray? So I think the combination of a few things. I think now we have what is virtually unlimited computational horsepower via the cloud environments and this kind of exponential kind of Moore's law increase in computer horsepower. Taken with, I think, huge amounts of data availability, complexity and complexity and just sheer volume. And then combine that with, I think, some of the machine learning breakthroughs that have taken place. And we've got this opportunity now to train machines just like a human would learn. I was joking with the guys at Boosted that I actually had a newborn baby 3 weeks ago, and I'm kind of, watching her wake up to the world and start kind of learning and analyzing. And, it's not terribly dissimilar to how a machine would learn. You make your way in the world, you try things, they work, you do more of what works, less of what doesn't, and you iterate towards some goal function. And in my daughter's case, it's being happy. Look at the data. This is kind of one of the key ingredients to this exercise. And I think there's been this explosion of alternative data sets, and that seems to be kind of one of the dominant themes in the investment management industry, is kind of get my hands on the most interesting, novel alternative data set that I can then extract insights from. But the data size and complexity and I think the speed at which it's being captured is becoming almost impossible I think virtually impossible for a human to keep pace with. And so we require these very powerful pattern recognition engines to not just process the data and to shape it, but to kind of extract those insights and to present them back to us in a way that we can act on. One of the cool things I think gets me really excited about AI, and I think why I, kind of made the leap into, a company like MindBridge and now, helping with the build out of Boosted, is, this kind of competitive advantage that to me seems a little bit unfair. And it's this virtuous cycle of AI. It's this idea that, those who create the best products, attract the most users. Those users bring with them the most data. That data then improves the product. And once you repeat that, it actually becomes impossible for number 2, 3, 4, and 5 to catch up to the leader, because the leader is compounding and growing at a much faster rate than anybody behind them. And I think, if you can get to market with really powerful tools, and kind of set your business up in a very agile way, you can just race ahead. And that's kind of what I've seen in kind of my 2 data points that I've had, where the more people that you get involved and the more customers you get signed on, they all bring unique opinions about how this capability can be deployed. And if you could iterate very quickly, the whole roadmap gets populated, not with what we think, but actually how the customers want to use the tool out the horizon. So, a very, very cool capability. You think about the alternative data explosion. I kind of, talked a little bit about, some of the core ingredients to these machine learning engines, with, I think, alternative data being this really kind of exciting part of it. I think, about 50% of hedge funds are using alternative data as of 2020 to, feed a lot of their alpha generating machines. And if you kind of zoom out, the financial markets, I would argue are kind of one of the most magnificent and complex systems we've created as a civilization. It's the amount of interconnections and data points. It's effectively this kind of a value-based system where all of the global entities are fundraising, and global participants are incentivized by the prospect of I think financial gain to capture all of this information and make decisions on trying to distill this population into a group of names that they want to invest in. So we can't really do that manually, and I think what we're finding is the use of machine learning tools are helping us process all of this information and to extract meaningful insights to put in the toolbox of a traditional investor. Why should portfolio managers be thinking about AI, and how can this help? I think I talk to a lot of investors every day, all day, and it kind of runs the gamut from quantitatively endowed long short hedge funds to more traditional long only asset managers to foundations, endowments, insurance companies, and everybody is thinking about these problems, but are at very different stages of adoption. I think people are a little bit intimidated by the prospect that these kind of code-based machine tools are going to take their jobs, and I think there's some mythology around that, and really I want to use a lot of this exercise to dispel some of those myths and offer some actionable ways to get started. And I think one of the core things that excites me about AI in the asset management industry is this democratization of access to these very sophisticated technologies and strategies. I think for a very long time, advanced quantitative strategies have been the exclusive domain of the Rentechs and the Citadels and the Two Sigmas, and there's been books written and around the application of mathematics to solving the financial markets. And I think one of the problems is advanced quantitative tools have been seeming increasingly out of reach for we'll call more traditional investors, due to the complexity and the cost of building, maintaining, and understanding these systems. And what we're really trying to do is to offer these no-code, low-code environments that present the output of these very, very powerful machines to a user on terms that they can act on. And I think that's really the holy grail when it comes to these decision-making aids, is how can I present the results in an intuitive way and allow my user to be able to explain the mechanics and the mechanism by which the machine was able to solve the problem, or not for that matter. And I think there's a huge improvement in quality and speed of decision-making. When I look at the traditional investment approach, there's a huge amount of manual work that's done. I come from kind of a school of thought where you're essentially trying to look at all of the names in your investable universe, and you're doing a lot of fundamental workup where you're trying to find what is fair value for the name that I want to buy. Does that fair value diverge dramatically from what the market is pricing, and should I buy something that's cheap and then sell something that's expensive, and kind of going through this exercise. But it's extremely difficult and labor intensive to do a fundamental workup on all the names in your investment universe. So people end up using a lot of rubrics and heuristics and rules to kind of distill a list down into a more manageable subset. And what I think that AI allows you to do is to scan the universe and to distill these names, use it as a focusing tool to focus in on areas that you should deploy more human effort. And there are some benefits of that coexistence, and I'll kind of unpack that as we go. extracting insights and signal from complex nonlinear data. This is one of the things that I think is really out of reach for humans. The world is an incredibly complex place. There are hugely complex relationships that drive, returns in the financial markets. And a lot of them are very, very difficult to explain, and they're not simple or linear in nature. And the machine allows us to scan huge volumes of data and to detect patterns that would be imperceptible to the human eye. And I think that's one of the things that really offers a huge advantage, is this ability to objectively and scientifically bring rigor to the exercise, and to kind of move away from these kind of rules-based, heuristic-based approaches where we're really exposing ourselves to a lot of risk. This is one of the other pieces. In my conversations with global equity portfolio managers, I've always staggered by the amount of Excel and the complexity that finds its way into Excel. I almost think there's a relationship between the larger the AUM of the firm that I'm talking to, the larger the Excel sheet. You see 40 tabs with different discounted cash flow models that are all linked to each other and all feedback to some master sheet that we're not talking about Excel here. When I talk about machine learning, this is not kind of a formulaic linear calculations that are being made. We're talking about extremely complex pattern recognition engines that are processing huge amounts of data and presenting back a solution to a problem. I think Excel did a great job for a long time, and I've seen some beautiful discounted cash flow models. I've seen some absolutely beautiful market models. I worked at a central bank, so you can bring a huge amount of complexity to this Microsoft tool, but this is not where the market's going. We kind of need to leave Excel behind to a large degree, and to kind of unlock, I think, a lot more of these non-linear, much more computationally intensive applications that are much easier to interface with. I think thematically, the conversations that we have with the global investment community, and you'll kind of see this in some of the CFA reports, the work, any of the reports from the World Economic Forum, as part of their Future in Finance program. There is an increasing role for AI, but I think there's definitely some skepticism. We're kind of, we're entering, these kind of waves of adoption where you are seeing kind of a first mover advantage with some of the more sophisticated, well-endowed asset managers, with, the rest, let's call it the bulk of the list, kind of waiting and seeing and kind of, dipping their toes in as they go. And this has kind of been an interesting exercise as I've joined Boosted, and we've kind of approached the asset management community. I came from a world where we sold into the audit world, which is an $80 billion market, 40 billion of which was captured by the big four. You move into the asset management world, there's $100 million or $100 trillion worth of equities managed globally, 1% of which is captured in management fees. That's a $1 trillion worth of capturable market. And so it's a very big problem to solve. And then you look at the market fragmentation, in the US alone, there's 19,000 FINRA registered asset managers that have over 500 million under management. So this is a huge list. And if you look at that list, and I've got the spreadsheet if you ever want to take a look. The top 5 names, the Fidelities, the Vanguards, the T. Rowe Prices of the world, these firms, the BlackRocks, they're going to have the ability and the wherewithal and the willingness to embark on, building some of these techniques in-house. They're going to, have an innovation laboratory. They're going to, attack this problem with all the money that they can throw at it and resource. And they're going to be able to hire the likes of, the MIT, machine learning engineers, the Caltech, extremely high demand, machine learning data scientists that are kind of choosing between Google, Amazon, Microsoft, and probably the biggest, global investment banks that they can find, and the salaries are insane. So, we're having to, understand how the rest of the market is going to approach this problem. And so, 80% of an institutional investor survey believe that new technologies will fundamentally change the way they operate, but they're not really sure how to get involved. Do they kind of build it themselves? Is this something that, they've got to go hire a PhD quant intern that is going to go build it? Actually, this is kind of a funny story, but I had a call with a very large Canadian pension fund, and they had just gone out and got an intern from one of the biggest engineering schools in Canada called the University of Waterloo. And we were on kind of a first call demonstration, and we showed the Boosted AI platform, which I kind of will describe in a lot more detail later. And they go through this kind of 1 hour demonstration, and the CIO of this pension fund looks at the intern, and they're like, "Okay, so yeah, that's kind of what we're looking for. Do you want to go build that?" And the guy's like, "I don't know what you think we're learning in engineering school, but it's not that. It's not that. This is not going to be an easy project. If you give me 3 to 5 years to research this, I could probably get you some code in year 5. So this is not something for the faint of heart and to embark on. So we've really got to think creatively about how the market folds into this capability. And one of the slides that I really like, and Klaus Schwab, who is he's the chairman, the founder, and the chief executive of the World Economic Forum, has spoken quite a bit about the fourth industrial revolution, and I think this is a theme that's been kind of dominating headlines in the market, that we are now kind of entering this kind of last phase where everything that a human can do, we've mechanized. If you look at the industrial revolution, the farmers in the fields, were displaced in favor of more mechanized farming equipment. Quality of life improved dramatically and efficiency improved dramatically, but there was always, the Luddites that kind of looked at this and saying, what am I going to do? And, everybody kind of retooled and actually found jobs, and new jobs were created by this technology. Instead of kind of farming the field, you're building the tractor. Similarly, we're entering this kind of white collar, that's very much staring down the barrel of technology being able to capture a lot of the decision making and the what we'll call rote, low cognitive, repetitive work that happens in banks, insurance companies, and most corporations around the world. And I think we're really reaching a tipping point where, if you look at the investment management industry, 10% of institutional investors are currently using machine learning in their process. And this expands the full gamut. This isn't just, the asset management or what we'll call institutional asset managers. But then you look at by 2025, 80% of institutional investors believe AI will be a dominant part of their process. So we've got some catching up to do. And the way that this typically unfolds, and this is again, from Michael Porter, his competitive strategy and analysis of industries, it's kind of a typical pattern when you see a wave of replacement. So as you see technologies come online that basically dominate and end up fully replacing older technology, you reach this inflection point where certain types of technologies end up kind of overcoming the barriers to entry. So in the case of machine learning for asset management, you look at things like financial resources, this need for domain expertise, people that have to understand the problem, a technical endowment, the ability to actually code this up. You need people with machine learning backgrounds, computing costs, data assets, speed, and agility. These are all things that have been huge barriers to traditional investors actually adopting this. And now what you're seeing is there's technologies like AI, cloud computing, quantum mental, platforms as a service, wealth tech, fintech, et cetera, that have just decimated these barriers and that are now creating this huge wave of replacement. And so that's kind of what we're starting to see unfold. But, rest assured, I know, just looking from the attendee list, we had a really good gamut of folks, and there were a lot of what kind of would fall into my category, the traditional CFA, MBA, business school folks, that are kind of feeling a lot of anxiety. I call it shame, worry and concern that how do you compete with this? Like, what is the value of a CFA on an asset management team in 10 years that can't code? What is that going to look like? How do you monetize, that experience? And, I think the answer to that, and this is at least what helps me sleep at night, is AI will not replace portfolio managers, but those that harness the power of machine learning will replace the PMs that don't. So think about this not as a replacement, but something that can augment your abilities. Think of it like superpowers that will allow you to dominate your competition. One of the things that is really, I think, unique to the asset management industry is that you've never talked to an equity portfolio manager that hasn't said that equity and performance and returns are their number one priority. And I would say, that's kind of universal. And if I ever spoke to a PM that said, yeah, returns are not really on my agenda, I would be shocked. And so it's a hugely competitive performance sport, and everyone's constantly looking for an edge in a way of kind of squeezing out additional return from their portfolio. And AI and machine learning tools really are that kind of augmenting power that's going to allow them to get there more efficiently. And we're facing a shifting institutional investment landscape. I think this is something that's becoming very clear, that the days of a traditional stock picker that sits on their armchair and reads the newspaper and uncovers outperformers is effectively done. I think quantitative investors, for example, who are your counterparts, are scanning the investable universe with incredibly powerful machines, driven by algorithms to uncover mispricing and to solve for the exact position size that will maximize outcomes. This is very difficult to consistently beat that by kind of stumbling upon names and relying exclusively on, intuition and to drive these decisions. So, I think we've got to accept the fact that there's going to be increasingly technology is going to play an increasing role in the investment industry, and that's something that we can not make strange with, but actually accept and welcome into our process. And I think the continued theme, and this is something that continues to dominate, is kind of this combination of fundamental and quantitative. Quantamental is this term that you hear that it kind of captures the essence of what the investment industry, I think, is going to, it looks like currently, but will continue to look like. I think one thing you're seeing is kind of this movement away from kind of this sleepy old discretionary balanced portfolio that my parents used to buy. I think when I had my college savings fund when I was born, they put me in some moderate risk mutual fund. My generation doesn't really buy those, and then that's kind of a dying breed. And you're kind of seeing this shift with JP Morgan Asset Management shifting a huge amount of their assets toward active ETFs. This ability to thematically engage with the markets and to kind of invest on your own terms, I think, is something that's not going to go away. I think there's a need for technological differentiation in the face of fee compression, huge amounts of competition and consolidation. There's discussions that Invesco and State Street will consolidate to create this $7 trillion behemoth, and I suspect that that's something we'll continue to see as the market needs to fold together to more efficiently generate returns in the face of really heavy duty competition and technical competition. The rise of retail, again, is a big theme that I think has been something that we've been monitoring closely at Boosted. And there's a really interesting blog post that I can share with the group about how we've used machine learning and pattern recognition to detect things like the GameStop phenomenon and to prevent short blowups. And it's a really interesting way that we've used pattern recognition to kind of navigate a world where traditional rules don't apply. If you kind of talk to the fundamental investor of the past, they'd look at something like Tesla and they'd try to come to some kind of fundamental understanding of what the value of that business is. And I was talking to somebody yesterday about this, and there's an old line about what the financial markets are. And you can kind of think of it like a beauty contest. It's not necessarily what I think is beautiful, because everyone has unique tastes. It's what the market thinks is beautiful and what the market assigns value to. And so that can diverge dramatically from fundamentals. And what's neat is the market contains huge amounts of information, and machine learning tools can actually learn those novel patterns such that you're not stuck with old rules and heuristics that may be held prior to COVID, and then after COVID it's a whole new world order and everything that you've done historically has fallen over. I think COVID and again, work from home, cloud acceleration is kind of pushing this need and this adoption of cloud-based tools. We're a cloud-based tool at Boosted. MindBridge is a cloud-based tool, and I think what we're finding is licensing these cloud tools that help your portfolio managers or your professionals make better decisions is just dominating. And I think COVID has accelerated that adoption and kind of knocked down any barriers to adoption that might have existed kind of prior to the pandemic. Technology continues to transform finance. I think, you've seen this stepwise improvement in how we've integrated technology into the process. And I think, machine learning and pattern recognition is kind of a logical extension of this process. And when I kind of think back to, how I would see the world, a traditional fundamental approach. You kind of have I kind of came from a global macro background. When I worked at the central bank, I spent a huge amount of time analyzing, monetary policy and, shifting, global macro themes, and then understanding how those global macro themes would impact, specific global sectors or regions, and then kind of continue to make my way down towards industries and companies. And the way that a traditional fundamental investor really approaches the exercise is it's this incredibly complex focusing undertaking, where I basically got to start with this huge list of investable assets, and I've got to distill that list down into a handful of names that I think are worthy of portfolio inclusion. And by worthy of portfolio inclusion, I mean that those are going to outperform the rest. And so you'll start with this criteria. You'll have some investable band that you're going to invest in, or some different regions, and then you'll kind of use some different screeners, let's call them rules, to kind of distill that list further based on idea generation. And then out comes the spreadsheet, and I'm going to go and do the discounted cash flow 17-step multi-touch full-on workup of these individual names. And then I continue to make my way down and convince myself that the names that I've selected and done the homework on are the ones that I want to take through to completion. And there's a huge amount of manual exercise and work that goes into this, and it's fraught with bias. That's one of the things that I absolutely kind of love looking at is the idea, the Daniel Kahneman Thinking Fast and Slow, the decision making or decision science. He's got a new book called Noise, which I think further validates my thesis that the reasons that I've made mistakes investing over my lifetime fall tidily into these human biases. We're these biological animals that seek return, avoid risk at all costs. We're very, very poor intuitive statisticians. We get very emotionally attached to names. I was talking to a guy yesterday about this, and he would do a 17-step fundamental workup on a name that he wanted to invest in. Do you think after doing 17 steps and writing a 40-page sell-side document on a stock, that if information presented itself on the next day, that you would, in a very unbiased way, integrate that new information and dispel your thesis? Probably not. I think you probably discount the validity of that new information to really continue to try to tidily fit your narrative around why that stock is worth the time and effort. And I think that kind of attachment and that emotion just burns humans like all the time, and it's really kind of sad to see. But human strengths are really in the creativity and the potential novel decision making. I think our ability to make intelligent decisions on the back of limited data and to make calculated risks and to proceed in the face of imperfect information is really one of our strengths. We're very limited in our information processing capacity. I think, I was, joking with the guys yesterday that if you gave me a list of 10 stocks and you said, Eric, I want you to rank them, you probably get a very different list of rankings based on whether I had a coffee or not. That's not something stable that you can deal with. A machine needs to be completely objective. And if you ask it on one day versus the next, regardless of whether it had a good sleep or not, you're going to get the same 10 names in the same order. Cognitive biases, this is really, kind of gets us every time. And, we're very susceptible to noise. I think we have a lot of difficulty differentiating between what is true performance signal and what is, really, predictive in nature. There's about 180 human biases, and some of the ones that I kind of like the best are kind of confirmation bias, availability bias, excessive coherence, the ones where we're really trying to shoehorn any new information into a tidy narrative about what's driving the market. When I was a junior at CIBC World Markets, I used to call one of the other analysts, and at the end of every day we try to explain to each other what drove assets in the market. And we would kind of seek out this exercise where we challenge each other on risk on, risk off, this went up, that went down. And some days we kind of look at each other and be like, I have no idea, everything seems to be moving in the wrong direction. And the reality is that's what happens. Not everything is going to be explainable and tidy and kind of compartmentalized into our rules. Machines, on the other hand, huge data processing power. Machines can identify very complex nonlinear relationships and really make objective decisions. They dominate humans on low cognitive, repetitive checking, computational tasks. But I think where the machines kind of fall over is they're extremely rigid. They only really can do what you tell them. There's kind of a lack of context often times, and there's potential statistical traps. I think Josh has talked a lot in some of his webinars about p-val hacking and some of the ways the machines can kind of fall into traps. And I think one of the other pieces is humans really need to be able to understand and interpret the results of the machine in order to execute. I think human judgment and human in the loop is kind of going to be a durable part of how this unfolds, and we really need to make sure that a human is kind of always involved in the process. So how to address, I think, the weaknesses of both, it really comes down to that kind of human plus machine and moving towards that quantamental thesis that machines can, machine learning can make nonlinear connections, but they're driven by a human professional and can explain its reasoning back to the user. And the resulting human plus machine decision making results in better performance than, let's say the human or the machine operating alone. That kind of falls into the Gary Kasparov, IBM, chess match. Gary plus machine can dominate the machine, or Gary independently, working independently. So, that's kind of one of the core ideas here. And so quantamental investing, kind of, I think of it kind of putting into the blender, you've got kind of quantitative techniques, you've got fundamental investment approaches, and you've got all of this data and computational horsepower. And you're going to distill all of that information into actionable data-driven investment decisions. You kind of look at both sides of the fence. You've got, quant and systematic approaches, kind of the Jim Simon of the world from Renaissance, thinking about how do we predict returns worth it, versus like a Warren Buffett who's saying, what companies offer the best return, kind of thinking about those questions differently. Large number of stocks in kind of more quant systematic strategies, more concentrated portfolios, and we'll look at fundamental, unlimited ability to process, and a little bit more data limited, cognitive limits, and more of a fundamental approach. And one of the slides that I think really illustrates why we kind of need to move away from traditional rules, or at least augment these rules with more machine learning and pattern recognition is, let's say that we're starting the investment exercise, and we distilled down into an investable universe. We're going to invest in the ASX. And we think that we like all the stocks that have earnings growth above Y and that have PE ratios above X, and then we kind of draw a line on the market, and then we say, okay, well, these are all the stocks that kind of fit that criteria, and so then we're going to use that as our starting point and do all the homework on those specific names. That's great, but rules are unstable. They're not durable. They, really require a lot of pre-existing knowledge about what drives returns to actually come up with a rule. Whereas machine learning and pattern recognition, this is finding novel, strong, relationships in huge amounts of data that would be really impossible for a human to detect. And so by augmenting your abilities with this pattern recognition, machine learning engine is going to bring a lot more rigor and science to how you're doing your idea generation. Kind of use this archetypal iceberg, approach to say, we want to surface the unknown patterns in the data. You look at traditional rules-based approaches, that's kind of limited by our understanding of the market. In order to create a rule, we have to know, first of all, what we're looking for, and then we've got to create a rule to find it. Whereas the machine learning and pattern recognition can actually help us find those unknowns in the data. The merits of quantamental, I think they're kind of far-reaching. It kind of applies, covers the blind spots of both sides of the house, and produces better outcomes. I think Jamie Dimon kind of summed it up with saying, the battle is more in the technology world at this point than just having brilliant traders, that you're employing at a huge sum. They really need to be quantitatively savvy, or at least understanding it and being able to work with these machines. So, these are forward-looking strategies, helping you to uncover potential opportunities and to navigate any regime shifts. Pattern recognition is key, identifying non-intuitive patterns. And I think time to value, being able to use these AI tools actually speeds up the process and helps you access, these insights quickly. And, if you think about the build or buy decision, this is kind of a question I get all the time. It's saying, okay, well, I clearly, I know I need to be doing something, but do I embark on the multi-year process of building it? So what does that look like? So I'm going to go hire a bunch of people from MIT. I'm going to get some guys from Caltech, Harvard, Stanford, biggest engineering schools I can find, if I can find them. I'm going to pay them huge amounts of money. $500,000 a year is kind of the starting point for a conversation with some of these folks. They're all going to have to be very, very deep technicians in all various machine learning tools. This isn't someone that took a Python course on Coursera. This is going to be someone that wrote a dissertation on this. It's going to cost a lot of money, and there's no real certainty that at the end of this 3 to 5 year research exercise that you're going to have a usable tool. Versus just licensing the technology from a provider that specializes in that one specific use case and getting it right and iterating very, very quickly towards success. So, the choice is yours. Just talking a little bit about Boosted. So Boosted, this is the company, that I work for. We have actually built a very powerful equity portfolio management tool. And you can kind of think of it as, kind of a digital laboratory or a workshop for portfolio managers that want to solve for a particular portfolio outcome. And so by combining big data, investment expertise, you can actually rank all the stocks in the universe and then create dynamically optimized portfolios using that result. Really cutting edge. We've got a great team, and I think you have the initial traction to kind of solve the problem. I look at our experience, and we've got kind of this unique combination of domain experts. So, I work for a gentleman, Spencer Rich. He's a former hedge fund manager from Tiger Management, and then at the other side of the house, we've got machine learning engineers that have sold companies to Microsoft, that work for Uber, all the big tech companies. So, incredible roster, and I think this is kind of what it takes. You need to have depth in both areas, because these solutions aren't necessarily just built by machine learning engineers. You need to have people that understand the problem and that can define, the problem. We have had great traction working with about 35 institutional asset managers globally, with a combined AUM of about 750 million, very global client base. This runs the gamut from large institutional, long only asset managers, sovereign wealth funds, to long short hedge funds, that are looking to kind of augment their process and bolt in additional signal. We are backed by Power Corporation, which is one of Canada's largest old school financial institutions. They've got a fintech investment arm called Portage that ran our rounds. And the way that we generate these ideas is you kind of think about that typical investment process, the universe screening, fundamental research, all the way down to portfolio construction and execution. You're kind of distilling down into smaller names, and then you're executing. And the way that we do that is, as a CFA, I would kind of log into the tool. I'd select my investment universe. Let's say I want to look at the S&P 500. What do I think drives returns? So I would define, any, variables that I think have predictive value and that help predict returns. And the machine then goes back through time and learns, what stocks in the universe are sensitive to what names. And then it makes a variety of predictions based on the likelihood of those names performing over the investment horizon. And it uses an algorithm that we call battle royale noise reduction, and essentially is a battling algorithm that takes, let's say there's 500 names in the S&P 500. It's taking all of the pairwise combinations of all of those stocks and is battling them head to head, with the idea of getting stock number 1 all the way down to stock 500. And then we're taking those ranking output and we're running a portfolio optimizer to create a smaller subset of names that we can then deploy in the market. And so you'll see this kind of step 1, it's the performance ranking. So we're defining the objective function. We want to maximize alpha. And then in step 2, we're putting in all of our portfolio considerations and constraints to get the machine to solve for a portfolio in the context of how we've constrained it. So let's say I want to minimize my turnover. I want a portfolio of 20 to 50 names. It's going to solve for the exact position sizes of each of those names that I should deploy in the market to win. And what the machine does, it does an excellent job at separating the winners from the losers. Breaks it out into its quantile spread. So if I buy the top 20% of the names, I'm going to earn X, let's say 20%. If I buy the bottom 20% of the names, I'll actually lose money, or I'll earn very little. So it's categorized all of the names based on their likelihood of performance. And what we do, I think, a fantastic job of is actually presenting back the ideas in very explainable ways. Again, I don't code, I never will, but this machine can show me all the positive and negative drivers of the stocks. It tells me which one it likes the best, which one it likes the worst, for what reasons. let's say I want to put a reopening trade on and I want to buy a cruise ship. Do I like Royal versus Carnival? The machine will tell me, why it likes Royal versus Caribbean or Carnival, and for what reasons and for what fundamental drivers it actually prefers. So it allows me to interface with it and to kind of test my own assumptions. And I think yeah, you can kind of see we kind of bolt in, your capital markets expertise. The machine goes in and learns from nonlinear and linear relationships, and then, detects patterns in the data and produces an output, so a portfolio that will produce the highest return. So the benefits of using AI for idea generation is, these trade ideas. So being able to kind of dynamically rank all the stocks in your universe, any inflection points. Looking at explainable AI, this is something that I think we've done a fantastic job at. We really put the user experience at the core of everything we do. Whenever we're going to add, new features, we test that against usability. And we're really building the tool not with our most tech savvy client in mind per se. We're actually building it from a usability perspective towards the least tech savvy portfolio manager on your team, such that a guy like me can navigate all the way to the end with fairly little problem or difficulty. But also your most sophisticated quant guy, there's all sorts of off ramps where they can access deeper, more technical aspects of the tool. By taking these kind of off ramps into, factor timing or semantic risk analysis, or going down into some of the deeper, technical features. And so the kind of core use cases that I think most of our clients will use it for is, dynamic stock screening. This is kind of ranking all of the names, finding out what I should do more work on. The machine learning overlay, this is essentially taking, let's say, 10 names that I have on my conviction list, and it's actually solving for the exact position sizes of each of these names without adding or removing any names. It can squeeze out additional return. Targeted baskets, coming up with proxies. If I have some kind of thematic view, I want to create a basket that has exposure to different features, I can use this tool to do so. Very, very powerful factor analysis functionality within the tool that I think a lot of our clients are finding very, very useful. Alternative data set evaluation, being able to actually upload alternative data sets that you might have purchased and kind of testing it for validity. Does this have predictive signal? And actively traded models. We're working a lot with ETF providers, active ETF vendors that are actually want to use a tool like this to actually plug into an OMS, an order management system, and actually manage a kind of an AI-driven fund. And that offers a lot of differentiation capabilities. I think of the fund company in Overland Park, Kansas, that's got an old list of funds that nobody really wants to buy anymore. There's a lot of opportunity to kind of add some fresh, tech-driven options to the menu to either maintain or, let's say, increase the AUM, which is kind of the name of the game. And we do some really cool stuff. This is something we've done in just the last couple updates to the tool. We can actually extract, like, let's say I built a S&P 500 model. I can actually print out a one-pager that I can then distribute. This is great if you're heading into your morning meeting. You had a big weekend. You need 10 ideas, to bring to the group, to be able to then rerun your model Sunday night. Grab your one pager. It's got the top 10 names that the machine likes. It's got the names that it likes the least. And then it's got the delta, the rank delta. What are the names that are moving up dramatically in the ranking? What are the names that are moving down dramatically? And then using those inflection points to say, hey, are we looking at service now? Is that a name that seems to have had, its prospects change? Could we do a call with management? Could we do the more human element to validate whether this is real or not? And then just very, very quickly before we wrap up, I just, the explainability, I really want to latch onto this. This is a core differentiator, because the holy grail for any of these decision-making aids is a user like, me or any investor that doesn't have coding abilities to be able to interpret the output and to act on them. So you'll see all these really novel, useful applications of explainability within our tool. We use this word cloud to indicate what are the different features that are predictive of returns. We do feature importance, so all these kind of three-dimensional insights into is CAPM beta buy signal or sell signal? Should I have a high sector allocation or a low sector allocation? And then this semantic risk factor stuff is really, really cool. And I'll, be able to kind of expand on that in maybe a demonstration if that was something you guys were interested in. So, very quickly, to summarize, I'm really, really glad that you guys were able to attend. I think this is an incredibly interesting conversation. This was not meant to be a demonstration of the Boosted platform. I think it was really meant to be more of a discussion about some of the themes that are occurring, how to prepare for using a technology like this. And what I want to offer is anybody that did want to see a more technical deep dive into the platform, send me an email, just give me a call, send me a text. Go to our website, hit the book a demo form, and we can put some time aside to do a real deep dive into any of those features if that was of interest. So, maybe open it up to SK if we had any questions that have come in on the platform, and we can kind of finish up that way.
Definitely. Thank you for a wonderful presentation, Eric. We have a bunch of questions. Let's start with the ones that we can get with the time we have. Number one, I already get great returns on my portfolio. Why should I add AI to my process?
Yeah, we hear that question a lot, and I think the reality is that it's kind of a never perfect, never done mantra in all professions, and specifically in the performance sport of investing. That you've got to constantly be looking ways at improving your process, and I think it's a very healthy exercise to look at your investment process and to understand if there's ways of more efficiently generating those great returns. And I just encourage you to be open-minded. Great returns are not durable, as we know, and it's always finding the next opportunity or next way of making those great returns. So.
Thank you. Next question. I do not have any technical training, but have been in the finance world for over a decade. How do you suggest that I get started?
Yeah, I think you're in the right place. I think, believe it or not, your profile fits the majority of the people that I talk to, and actually the people with the deep machine learning background are actually a very, very small percentage of the investment community. So, I think the large majority of people are your traditional, stock picker, fundamental investors that don't have the desire or willingness or abilities to go and learn how to code in Python. And using a technology like this is a great place to start. Unpacking some of the different quantamental strategies and approaches is a great place to explore and to have curiosity.
Awesome. Can I use the tool to review some of my existing portfolios?
Yeah, absolutely. So that's actually one of the kind of the most interesting use cases, and really a validating exercise for a lot of our potential customers and prospects, saying, okay, well, how about I upload my portfolio, and I'll show you the decisions that I have made, and then we'll see what the machine would have recommended, and by those tweaks and tunes and adjustments on the edges, are we able to squeeze out additional return by just getting the sizing right? And that's kind of one of the biggest revelations for me, is that there's alpha that being left on the table. Every time I run through this exercise, people are taking this risk anyways. Why not size the positions in a way that squeezes out additional basis points on the edges? And who wouldn't want more return? I do.
Thank you, Eric. There's a few questions around video recording. Yes, we'll be circulating the video recording within the next day. There's a few questions around cost. I think you'll have to talk to Eric on a case-to-case basis to get that clarity. We'll move over to the next question, which asks, how long will it take me to learn your platform? Will I need to learn how to code?
Yeah, so this really fits into the no-code, kind of user experience. This is a product that walks through kind of a questionnaire workflow at the outset, where you're defining, kind of very high level portfolio, constraints. What is your stock universe? Do you want to upload a custom portfolio? What's the goal? Do you want to max raw return, alpha, min risk, run some optimizers? So it's just kind of walking you through, and none of it's kind of a code interface. And the machine does all the heavy lifting. So yeah, a tool like this would kind of be right in your wheelhouse.
Thank you. This is a rather long question. I'll read it out. Is there a way for a manager using the platform and applying the quantamental approach to evaluate how pure systematic application of the model compared to the quantamental combination?
Yeah, that's a great question, and actually this is a use case that we see being increasingly popular. When we started building the tool, we weren't sure that it would resonate very well with a quant crowd, but what we're finding is there's an old adage that you combine a variety of weak signals to create a strong predictor of risk. And so by sewing together uncorrelated signal, our signal plus, the quant firm signal plus, maybe another vendor's signal, by sewing those together, when all of those signals point in the same direction, you get added conviction. And so I would encourage, even some of the more technically endowed firms to think about using environments like ours to test their signal, combine it with other signals, and to see what the impact on their results would be.
Great. Is my process confidential?
Absolutely, yeah. So this is, if you think about, information security policies is kind of a dominant feature of any SaaS business. We really live and die on data privacy. What I would offer is the tool is fed by S&P Cap IQ. We've got FactSet data. We've got all sorts of publicly available, global macro currency, commodity, fixed income data, interest rate data, pre-programmed into the tool. And every client of ours has their own unique instance of, their own cloud deployment of the Boosted Insights platform that is ring fenced and not even accessible without to any of our team. With that, you can share it with your customer success representative if you've got an issue, but it's actually a completely contained container that's that you operate in. So yes, your data is very safe.
Wonderful. What are some of the risks involved in using AI for driving my investment strategies?
Yeah, I think one of the takeaways is this is not a panacea. This is not I'm just going to turn this tool on and go to the beach and it's going to run in the background. I think I really want to hit home that this is very much a human in the loop. The decision that gets made to invest. The machine is a decision-making aid. It's allowing you to look through a quantitative lens into the marketplace, identify what is meaningful performance signal, and then use that in your own decision-making to deploy a portfolio. There are instances where some institutional investors will want to put something like this in a more robotic, kind of autopilot, automated way. But I think most investors that are getting started with machine learning should use this as an input to the process, maybe not the process outright.
Thank you. What does it mean when you say your AI is explainable, and how is it different from other tools?
Yeah, I think that was, the last kind of 4 or 5 slides of the tool, I think highlighted kind of one of our core differentiating advantages, in that everything we do is kind of through the lens of how would a more traditional, fundamental investor look at this output. Is that something that would be confusing? I'm often part of a Slack channel, about the user experience, where we'll look at the one page and we'll say, does that 5 stars make sense? Does 5 star, should we have, different presentation? Is heat maps? We're constantly looking at ways of feeding back the output of the machine to be kind of a really elegant, risk dashboard for a user to act and to take data-driven action from.
Thank you. I'm sure you get this question 3 times a week. If your technology works so well, why are you selling it and not starting your own hedge fund? Yeah, no,
that's a great question, and actually is one I get multiple times a week. If you're so smart and Boosted is so powerful, why are you, not retired and on a yacht somewhere? And there's kind of a simple answer to that. If you think about what Boosted's done, we built a capability, and there's different ways of monetizing that capability. And so for us, we're technicians. There's a very, very powerful machine learning team at Boost, and we build fantastic explainable technology. And the best way for us to monetize that is to actually create a SaaS company and to distribute it to the market on a recurrent monthly basis. Because if you look at SaaS businesses, they command, 40 to 50 time revenue multiple. If you look at, more of a traditional asset management business like a hedge fund, you spend a lot of time fundraising, dealing with clients. It's a sales, just a sales job. At the end of the day, you're really trying to find and keep assets, and you might command a 1 to 1.5 assets under management valuation. So the SaaS model is a pretty good one.
Great. With that, we are at the top of the hour. Erik, any final thoughts before we wrap up?
Yeah, I would just highlight that, this is obviously something I'm genuinely enthusiastic about. This is really, really cool technology. We've got an incredible team of experts at Boosted. I would encourage you to reach out. We want to have these conversations. If you're doing something similar, we'd love to share notes and understand how we might be able to work together. There is so much interesting stuff to do here that we really want to connect with like-minded folks in the industry that are kind of tunneling at this problem. And so let's set up a demonstration. If you're a portfolio manager, CIO, et cetera, and this is something that you want to explore integrating in your process, let's get some time in the calendar and show you what we've got.
Great. Thank you, Eric, for taking the time and doing a great presentation.
Have a great
I'd also
day,
like to
guys.
say thank you. Thank you. Everybody who also joined us today, a big thank you to you too. Like we mentioned earlier, the presentation recording will be sent in an email within the next day. Have a great rest of your day. Bye-bye.